Starting off November on a high note, futures rise. 30 minutes until the start of the cash trade. I'm Matt Miller.
I'm Danny Berger. Bloomberg Open Interest starts right now.
Coming up, it is M&A Monday. Kimberly-Clark scoops up Tylenol maker Kenvue to create a consumer products giant.
Meanwhile, tech giants Microsoft and Alphabet are making more deals to build out their AI infrastructure.
And cash is king. Warren Buffett's cash pile at Berkshire soars to $382 billion, an all-time record for any company in the history of the universe.
Matt, some big deals this week. Also, I think my microphone might have fallen off me somewhere.
Did it drop? Did it drop? All right, you know what? I'll go do that. You replace me here.
Perfect.
We'll switch like in pickleball. Here, Kimberly-Clark right now down 14% as it gives a big premium to Kenvue in a takeover deal that could value the latter at $48 billion. It'll make Kimberly-Clark the second biggest seller of health and wellness products after Procter & Gamble. And to me, I mean, this begs the question, couldn't Kenvue have just stayed with J&J? Like, why leave one conglomerate to form another one? But I guess that's the way Wall Street works. Also, Microsoft inked a $9.7 billion deal to buy cloud capacity from Australia's Iren, giving it access to more Nvidia chips. Separately, the U.S. is going to allow Microsoft to ship more Nvidia chips to the UAE. And there is breaking news on another multi-billion-dollar AI deal. Because it's Monday, that's when all of the M&A happens. Amazon's cloud unit and OpenAI announcing a $38 billion deal in artificial intelligence. This allows OpenAI to run its AI workloads on AWS. That's, of course, Amazon's cloud business. AWS infrastructure starting immediately. And Bloomberg Tech co-host Carolyn Hyde joins us now to walk us through this sea of deals. But let's focus first on AWS. Carolyn, what do we know?
It's a nice little chunk of change, isn't it? But compare that to the $300 billion commitment they were getting from Oracle. So we try and compare oranges with apples, potentially in some way here. But we are seeing that OpenAI is able to lean on more than just Microsoft. They went to Oracle, and now they can go to the juggernaut in cloud computing, which is AWS. AWS just proved themselves. On Friday, of course, on Thursday evening, we got the numbers out of Amazon, and AWS growth had re-accelerated to some 20% year-on-year growth. And they're managing to show once again that they can offer what they call tens of thousands of GPUs from Nvidia, but then also start to access Amazon's own vertical integration. There could be millions of CPUs made by Amazon themselves to continue the inference that they're going to be able to see coming out of OpenAI, but also the training of models. Really Amazon trying to say here, look, we know how to run these enormous data centers, and we're going to do it. This is just the start of a 7-year relationship, and they're actually going to get this compute up online by at least the end of 2026, and then expand thereof. So that $38 billion could continue to increase. And we know that OpenAI has just got a never-ending need for compute more broadly. So once again, another deal coming from the cloud computing giants out there.
It feels like every single day the web of interconnectedness just grows more complicated, because there's Microsoft as well today inking a deal with another cloud provider and bringing Dell into that deal as well.
Yeah.
What's that?
And Nvidia.
And of course,
I mean,
and Nvidia too.
All paths lead back to Nvidia, which is supply the GPUs for all of this sort of cloud computing. But what's interesting here is Iren is an Australian company, but actually has significant
Iren. That's how we're going to say it.
And
Iren.
that's how we're going, amongst friends, going to call it.
That's fair. That's fair.
Send in notes if you know any are different. But Iren is saying that it's going to be offering its actual Texan-based compute. Remember, this is another example of a neo cloud that used to be a Bitcoin miner. You've seen that with CoreWeave, you've seen it with some of the other players, Nebius over in Europe, and Australia's been doing the same thing. They've got big offerings here in America, and they're able to offer that out to Microsoft, which we know is not able to capitalize on the amount of demand because they've got a supply issue. We heard that from Amy Hood, the CFO, on their earnings as well. This is a company that's having to allocate more capital expenditure. They're building out their own, but they're also going to neo clouds more broadly. We've seen Nebius as one, we've seen Nscale as another, and now they turn to more access in America. So it's interesting that we're seeing Microsoft still having to double down.
Neo clouds are what we call just businesses that don't have any other business besides cloud.
They just know how to run a data center efficiently, and then they go to a Dell and buy all of the equipment, whether it be the servers, the chips that go inside the servers. And we got some real detail on the numbers here. They're saying, look, I'm paying $5.8 billion, this is Iren, to Dell for the equipment. But then longer term, this is a more than $9 billion deal with Microsoft. You're starting to understand some of the margins, some of the operating costs more broadly.
Elsewhere, more debt. That seems to be the theme,
debt,
right? Have a deal with someone and take on more debt. This time, it's Alphabet. It seems like it's both European markets and U.S. markets that it's tapping, but this is a completely different model for these tech giants, isn't it, to do so much of the growth in CapEx through debt?
Because usually it had been their own money. And actually, there's that $3 trillion figure out there coming from Morgan Stanley. And look, we're awash with numbers, so it can be hard to really understand. But $3 trillion is what Morgan Stanley thinks is going to be needed to roll out the AI data center spend to 2028. They think about half of that's going to come from these companies' cash flows, but the other half is going to come from interesting financing, whether it's Blue Owl that we see Meta turn to, or whether it's the debt markets, which Meta tapped $30 billion worth of last week. But now we see Alphabet go for 3 billion euros over in Europe. They already did their first European sale at the beginning of the year. And then they're tapping the US markets as well. And look, interest rates have been coming down a bit. This is an interesting way to continue to show your commitment to growing. And of course, remember, Alphabet, we rewarded for spending more on their compute last week. We're seeing the growth trajectory for Alphabet and for their Google offering.
And we are speaking to PIMCO President Christian Stracke later in the program, who helped lead one of the Meta debt offerings. Caroline, thank you so much for joining us. Caroline Hyde of Bloomberg Tech, and she'll have more on the Amazon OpenAI deal later in her show, and we'll also have it more for you this hour with Bloomberg Intelligence analyst Anurag Rana. Some other big deal news on this Deals Monday. Kimberly-Clark buying Tylenol maker Kenvue for about $40 billion or more. We're joined by Bloomberg managing editor for global business, Eric Fanner. Eric, it was a company that J&J didn't have success with, so they spun it off. It didn't work as a spin-off, even with all of the activist investors circling around it. Why should its fate be any different with Kimberly-Clark?
Yeah, that's a good question. I mean, this whole consumer health area is one where we've seen a huge amount of activity in recent years with a bunch of big pure play pharma companies like Johnson & Johnson getting out of the area, out of this area. We've seen it also with companies like GSK, Pfizer, and others, all kind of moving to separate or sell or spin off their consumer health brands. So that's created a whole bunch of new players like Kenvue and some others, Haley and over here, which are sort of floating around, and people are looking for new partners to attract scale. And so that's where Kimberly-Clark comes in here, and they immediately then get to rival the biggest player in that sector in consumer space, which is P&G. So you get to form a big new player that immediately vaults ahead of some of its close rivals. So you got more scale, which is key for these companies in an area that has a lot thinner margins than the traditional pharma business that they were attached to with Johnson & Johnson.
It also begs the question, what's Kimberly-Clark's relationship with President Trump like? Because he has led a huge attack against Kenvue's biggest product, right? Tylenol. Acetaminophen is, of course, the drug that's the main ingredient there. Do you think this company is going to have any plan to deal with the president better than Kenvue did as a standalone?
Well, that is a really good question, and as you say, this is something that's weighed on the share price for Kenvue. Their sales have been falling, not entirely due to this, but it's definitely been under pressure from this attack from the Trump administration, linking acetaminophen, Tylenol's active ingredient, to these claims of autism, which haven't been proven, of course. And so it is a really good question. How do they deal with that going forward? There's a real risk here in these kinds of deals when you take on that kind of a liability. So definitely an element of risk, yeah.
All right, Eric, thanks so much for joining us. Eric Fanner there talking to us about one of the biggest deals that we've seen today. Of course, there have been a couple of more than $30 billion deals on this Monday. Let's stick in the healthcare sector and talk about Pfizer. It is suing Metsera and Novo Nordisk in an effort to block Novo's bid for the former obesity startup Metsera. Pfizer says Metsera breached its earlier merger agreement by declaring Novo's offer as superior. We know that last week Pfizer said it was reckless of Novo Nordisk to make the offer that it did. Bloomberg health team editor Cynthia Coons joins us now. So they're really getting aggressive here.
Yeah, so this is Pfizer's second lawsuit going after Novo and Metsera in 4 days. Clearly, Pfizer's trying every grounds to stop this. On Friday, they tried to get a temporary restraining order to stop that deal from moving forward. But while that's being worked out, they're going in with the antitrust angle, and they're arguing that they would be a better owner for Metsera, that Novo already has a dominant market position, and that it would basically hurt consumers. So that's their latest play in this.
Underlining it, is it just a Pfizer that's behind in obesity medication?
Yeah, Pfizer needs a good deal. I mean, Metsera is not the only company out there, but they did strike what they see as a good deal. Metsera agreed to the deal with Pfizer, even though it wasn't the highest offer they got. So there were, I guess, a sense that perhaps Pfizer had a better position from an antitrust perspective to get the deal done.
And they're closer to the Trump administration.
Yeah, so that on Friday, Pfizer said that they had gotten through a big step in the regulatory process on the antitrust front, and that was surprising because actually those kind of clearances haven't been granted during the shutdown. So Pfizer does have a better hand to play here, you would think, but Novo's deal is higher, and Metsera's board so far has said that they perceive that to be the superior offer.
Interesting. Cynthia, thank you so much for joining us this morning. Bloomberg's Cynthia Coons, and a quick check on futures this morning. After 3 weeks of straight gains, will this be a fourth 6 months of gains for the equity market too? That's the longest winning streak since 2021. Tech has been outperforming all October. It continues this first day of November, outperforming too, up 0.8%, while the Russell 2000 declines 0.1%, Matt.
All right, let's get a look at some of the other movers on our radar. Amazon and Nvidia both jumping on Amazon's $38 billion deal with OpenAI to supply Nvidia chips, and that's only one of the deals we've seen this morning that involve Nvidia chips.
And I'm most excited about this because that insane graphic we have of the interwebbing links of everything can now just get even more complicated.
Yeah, we can update that. I don't know if Dell was in there. We can put a Dell circle in there.
Yes.
Joe can hook that up for us.
Yeah, I can't wait. It'll be even more confusing for everyone looking at it. Also, some other deals this morning. U.S. precious metals producer Coeur is buying new gold for about $7 billion. That will bolster its Canadian operations, with gold still trading around $4,000.
And another big deal, Eaton agreed to buy liquid cooling specialist Boyd Thermal, different than Boyd Aviation, for $9.5 billion to capitalize on AI data center demand.
And all of this putting deal makers on course for $4 trillion of deals this year. And more U.S. shale consolidation. SM Energy will be buying rival Civitas in an all-stock deal. That one's worth $2.8 billion.
Coming up, Berkshire Hathaway rising pre-market after announcing a record cash pile. But is that really good news that they have no idea what to do with their money and apparently don't want to use it to buy their own shares? This is Bloomberg Open Interest. Let's get out of high interest. Look what's making headlines around the world. OPEC Plus will boost oil output slightly in December, then pause hikes through the first quarter as it braces for a supply glut. The pause reflects an expectation for a seasonal slowdown and comes during a period for uncertainty for oil traders thanks to additional sanctions on Russia. The IEA warns global output may outstrip demand by over 3 million barrels a day this quarter, deepening fears of a record glut next year. Now, despite tariffs, deficits, Fed clashes under President Trump, money continues to pour into U.S. government debt. Treasuries are up about 6% this year. It's the best run since 2020 as falling inflation, just barely tinily falling inflation, and Fed rate cuts draw global buyers, with other economies facing their own strains. The U.S. remains the safest, most liquid haven, but risks still remain, including tariff fallout, a weaker dollar, and political fights over fiscal policy, if any of those things happen. Berkshire Hathaway's cash hit a record $381.7 billion last quarter as Warren Buffett stayed on the sidelines. In terms of M&A, operating profit jumped 34%, led by booming insurance results and unusually low disaster activity. Investors are paying closer attention as the company nears a new era, with Buffett handing off the role of CEO to Greg Abel at year-end. Danny?
Let's discuss those results further. Joining us now is Alex Rajmandari. He covers Buffett and Berkshire for Bloomberg News. Alex, it's the size of a cash pile equivalent to P&G, equivalent to Home Depot. today underscores that deals are happening. There clearly is stuff out there to buy. Why is Berkshire Hathaway still on the sidelines?
That's the big mystery. There's nothing in Buffett's eyes, it seems. He hasn't been buying any equities on the market. I mean, he has, but is a net seller of equities of $6 billion. There's been a string of quarters like that. And he hasn't been buying by his own shares, even if, the shares have been down 12% since he announced his retirement at the end of the year. I mean, he's stepping down as CEO. He will still be chairman. So that raises the question, like, is that a good thing? Really, the net investment income of the company has decreased quarter over quarter because of short-term interest rates falling over the period. So it's not really yielding more money for the company in terms of investment income. And it kind of raised the question. I was talking to an analyst yesterday. She was saying, look, if they have so much money that's yielding less and they don't buy their own shares, why should you?
Yeah, it seems to make the case quite well that their shares aren't at all undervalued, right? Otherwise, they would be buying them back themselves. And that the rest of the market is pretty fairly or even highly valued, because otherwise they'd be playing in this M&A extravaganza that we're seeing. What is it, $4 trillion?
Yeah, 3.8 at the moment this year.
In
So we're
deals this
just
year.
almost there.
Yeah.
So to be sure, Buffett has not done nothing in the past quarters. He's done, he bought this stake in United Health for $1.6 billion. He's buying Oxychem for $9.7 billion. That's in the fourth quarter, though. So we need to see, like, in a few weeks, we're going to know exactly what happened on his investment in equities. But it's true that when he doesn't buy shares, it means that he thinks that the intrinsic value of the company is below what it's trading at. And he's been saying that he doesn't see a lot of opportunities on the market, and the markets have been growing even more since he made that comment.
All right, Alex, great to get some time with you. And of course, we're going to continue to watch what he does with this cash pile. I want to take a look at some of the movers on our radar this morning. Semiconductor jumps after a third quarter revenue beat estimates. You can see well, I don't know if that's a jump.
Yeah,
really,
that's more of like an inch.
Yeah,
A crawl.
inches higher.
Crawls higher.
Yeah.
Palantir's moving even much higher than that, even though it hasn't reported results. Will report after the bell. Investors see revenue growth of 50%, so the bar is high.
Memory stocks are climbing as earnings and AI deals point to a demand upcycle for their products. These are actual jumps here.
Especially SanDisk. 5% counts as a jump.
Yeah, SanDisk, which you may remember from before phones had cameras built in, up 5%. Micron up 3.5%. Western Digital gaining 1 1/3.
Coming up, we'll get back to the broader equity market. Citi's Stuart Kaiser on the S&P 500 6-month winning streak, plus volatility risk from economic data once the government shutdown ends. All of that to come on Bloomberg Open Interest. One of Wall Street's biggest optimists is getting concerned about the bull rally, saying the S&P could fall 5% by the end of the year, which, by the way, would still be a pretty good rally for this equity market. Ed Yardeni says that he's getting worried that so much bullishness around equities is a contrarian red flag. He told Bloomberg, quote, "The crucial question is whether this rally has already gotten ahead of itself. Just one unexpected event could knock stocks down from their highs amid poor market breadth." Joining us now is Citi head of U.S. equity trading strategy, Stuart Kaiser. And again, I think it's important to say, he's not saying we're like headed for a bear market. He's like, yeah, maybe like a tiny little 5% drop. Is it a concern that there are so many bulls in this market right now?
I mean, is it a concern? I mean, valuation's high. Obviously, the markets have kind of gone through a lot of event risk and managed to rally. But there are still people, I think, that need to be convinced to own equity. So I'm not sure I would call the market max bullish. I think there's certain investor groups that are. But you got to remember, I mean, as recently as a few months ago, you were still in the U.S. exceptionalism is dead theme, and people didn't want to be in the U.S. So, look, a 5% pullback is always possible in any 2 to 4 week period. So I wouldn't dissuade you of that. But I would say that I don't think that every investor we talk to is max bullish. And frankly, I think there's a lot of people that were cautious coming into the fourth quarter to begin with, and probably could be convinced to get in the market into year end.
Got to be only institutional, right? Because what we hear from, for example, the St. Louis Fed is that American households have never been this exposed to the equity market. And ditto foreign investors. Like, even though they may have said they didn't want to buy America, they own more equities as a portion of their portfolio than they ever have. So where's the marginal dollar going to come from?
Well, look, I do think international investors, at least based on the ones we've talked to, have been playing catch-up probably since June to get more exposure to U.S. equity markets and more exposure to the AI theme, which, frankly, you can't own really outside of the U.S. Agree with you. I mean, retail investment volumes are setting new records every week, but it doesn't mean they're going to stop, right? I mean, retail investors seem very active. They were buying the market in April. They were buying the market on the pullback over the summer, so I wouldn't necessarily see them pulling back. In terms of, who's underweight, I do think some macro type investors are probably still a little bit underweight U.S. equities. They've been owning gold and owning other assets. I think they saw better risk reward in bonds and in gold and in FX. And I don't think anybody really thought the S&P could be pushing on to 7,000 by the end of the year. So I do think there's a little bit of catch up there. And frankly, look, seasonals look great into year end generally. Buybacks picking up after earnings. There's a lot of reasons to believe that you're going to have flows come into the equity market by year end.
Does the participation of retail, though, change this market? Does it make it more volatile? Or when you get the incremental fundamental information, does a larger adjustment need to happen if you've had this big cohort that's just been buying on anything?
I'm not necessarily of the view that retail makes it all that much more volatile. Yes, you have more zero-date options and things of that nature, but I actually would argue concentration on the institutional side and the way a lot of the pod shops invest with leverage and with favorite stock portfolios on top of their book might make things a little more volatile than retail necessarily. Like if you go back to DeepSeek, Nvidia was the retail favorite. That sold down, about 15% of the DeepSeek news. The AI power gen utility stocks, which I would argue are more of an institutional trade, were down 30 to 40%. So retail actually stepped in and bought their favorites on the weakness, whereas institutions were kind of forced to de-risk. So is there a risk that retail suddenly pulls back? There is that risk. There's a risk of anybody pulling back. But I don't think that we've necessarily seen retail creating more volatility in the markets.
All right, we're going to take a quick break because when we come back, the opening bell, kicking off the month of November. Stuart, we're glad to have you here to kick off the month of November after 6 months in a row, 6 months of consecutive gains for the S&P. Can we continue? This is Bloomberg. We are moments away from the start of trading, kicking off the month of November. This is Bloomberg Open Interest. I'm Matt Miller. With gains in futures, you can see right now S&P futures are up 0.5%, so we're accelerating that gain into the open. NASDAQ futures up even more as Nvidia rose more than 3% in the pre-market. The small cap's not doing anything right now. The bell on the New York Stock Exchange. Who is, I can't even see.
The slow reveal.
There, yeah, Q ringing the bell at the New York Stock Exchange, all in green, so I'm guessing that's a St. Patrick's Day company. And then here on the NASDAQ, Allegro Microsystems, which provides chips for power capabilities and sensor capabilities. Had a pretty good year, up 36%, although over the past 5 years, that's about what they're up as well, 45%. There's a lot going on in terms of M&A today, and you've got a board of a couple of those stocks in a deal.
It's almost as if it's a deals Monday, return to the market. Some big movers off the back of that. It is Kimberly-Clark and Kenvue. Kimberly-Clark will be buying Kenvue for an enterprise value of more than $48 billion. Kenvue, of course, makes Tylenol and other consumer goods. It also makes Kimberly-Clark the second biggest seller of health and wellness products after Procter & Gamble. Matt.
All right, we have even more deals today. Amazon and OpenAI struck a $38 billion cloud deal to help power its AI products. Microsoft made a deal with Australian data center operator Iren worth more than, or nearly, I should say, $10 billion. The U.S. is going to allow Microsoft to ship more Nvidia chips to the UAE in coming years. That's an $8 billion deal. And I actually was taking all these deals, right, and all this optimism. I wanted to look at the seasonality. Okay. So the Bloomberg has a function for that, SEAG Go, just to check out what's going on in November on average over the past 29 years, because that's as much as I can drag it out. It's the best month of the year on average. So it's like everything is going for us. We're back with Citi head of U.S. equity trading strategy, Stuart Kaiser. Is there any reason at all to be bearish?
Yeah, I mean, I think that there are reasons to be bearish. I mean, we have a federal government shutdown that's going on a month now.
Seems like no one cares, other than Newark Airport, right?
Other than Newark Airport. I mean, I think there's some people in the greater Metro DC area that probably are a little more concerned about it than we are up here. So there's a risk there. If you look at Oracle credit spreads, I mean, that kind of stuff is definitely eye-catching. That the amount of investment-grade debt that is getting issued and needs to get issued is pretty stunning. And we're going to have to see how well the market digests that and how well the stocks react. Look at Meta earnings last week. One of the first times that a company has announced large capex spending plans, not getting rewarded for it. So there's definitely some things out there if you wanted to squint. But look, the seasonality I think is really positive into year end. Buybacks are going to pick up post earnings. You're getting a lot of these AI deals announced. So path of least resistance definitely higher. But we could probably come up with a list of 3 to 5 things that might keep you up at night and ruin your Thanksgiving potentially.
Well, maybe all the good things are just happening for the S&P or for the Mag 7. In other words, the broadening out rally that's had fits and starts this year is currently having a fit. The equal-weighted S&P 500 fell last week. Tech outperformed. The Russell 2000 fell too. Is the broadening out trade over for this year now?
It's a good question you bring that up because if you look at year to date, it's actually the belly of the market, the S&P equal weight, that's massively underperformed. It's underperformed both small cap and S&P cap weighted. So basically what you've had is this huge demand for mega cap, and you've kind of had this low quality catch up. Our view is that that's probably not sustainable medium term. You can't have kind of the middle of the market underperforming both ends. I think that's more of an early 2026 story, to be completely honest with you. And look, that theme will get tested the next couple of weeks. We're past Mag 7 earnings. We're going to get earnings from kind of the quote-unquote rest of the companies, and we're going to have to see how they perform. But it's been a very odd year that way, that the mega cap and then unprofitable small cap have done well.
The chunky stuff has done pretty well, it feels like.
It's done stunningly well. It's up 20-30% in the last few months. So there is an issue there of, can this market rally sustain itself without the belly kind of getting filled? I would say probably not, but I think going into year end, at least the investors we talk to, if you're up this year, it's been a really difficult year. The odds of you getting creative with your portfolio going into year end, I think, are pretty low. So we think what's worked is going to continue to work, and that's probably high growth momentum leadership, kind of going into year end will outperform.
You have flagged, and we have touched on power generation. Clearly with the amount of capex that the hyperscalers are spending, with the amount of demand from all of us on ChatGPT or Gemini or Llama or whatever else, these places have to get power, and it's not going to be cool with the American people if it comes at the expense of tripling their bills. So who's going to fill that void? Like, what's your best bet?
I mean, it's a great question, Matt. I think what we've seen in the last few weeks is a number of states are now sort of carving out the hyperscalers and forcing them to pay a higher electricity tolling rate than retail investors.
How did it take them this long?
Well, I mean, it didn't become a political issue till now. I mean, if you watched a football game over the weekend, the number of New Jersey gubernatorial ads you saw that were targeted at utility costs, probably made you want to change the channel. I'm told the same thing's happening down in Virginia. So likely what we're going to be seeing is you're going to see alternative forms of energy get brought on, and you're probably going to see, the pricing dynamic shift a little bit to protect the retail consumer from hyperscalers kind of driving their utility costs higher. State of Wisconsin raised the ROE cap, for their local utilities. So my point is there are some beginnings of an effort to kind of balance this out and make sure that you and I are not paying, for Meta, et cetera, to develop more AI product.
One of the interesting twists of what's been happening just in the past week with the AI trade too has been the difference in treatment from the equity market and the credit market. I'm thinking very specifically of Meta here, where shares fall 11%. And then you have this big bond offering, and spreads for IG markets widened by like a whopping 2 basis points. The credit market has been acting more sanguine than the equity market in that case. Do you expect that dynamic to continue?
I'm not sure how that dynamic is going to evolve, but I think it's going to be in the crosshairs on a go-forward basis. I mean, we issued almost $80 billion of IG debt last week and over $125 billion of IG debt last month. Meta's fine, clean balance sheet, et cetera. Look at Oracle. They're trying to raise $38 billion to fund some of this stuff. Their credit spreads have risen consistently since they reported earnings. So I think you've got the large cap hyperscalers who have these incredibly clean balance sheets and massive free cash flow generation. They're going to be treated one way.
Yeah, but more of the debt's going off balance sheet too. I mean, they have clean balance sheets. Why wouldn't they just continue to raise the money on their own by doing all this off balance sheet financing?
I believe the term is financial engineering, but no, honestly, it's a good question, and I'm sure these companies know what they're doing in terms of managing their balance sheet and income statement. But point is, there is a massive amount of investment-grade credit coming on. You have a group of companies with the cleanest balance sheets in the world, and then you have that next tier who have good balance sheet but not great.
This is the DDIS function for Meta, and it shows that they only have $60 billion in debt. This is not including the 30 that they sold last week, but and it's a $1.6 trillion company. So that's a drop in the bucket. But as a shareholder, and this is, I guess, a basic CFA question, right? Do you care as an equity shareholder if your company is borrowing like tens of billions of dollars? Does that make you kind of want to sell some of the shares, or does it not matter?
Well, I mean, I think what we just showed there is with that cleanliness of balance sheet, when your balance sheet looks like that, most equity investors probably want you to issue more debt, right? Because you're borrowing at such a rate, and you can add leverage into it. For another company who might have more leverage, that math might be a little bit different. I think Danny raises an interesting question. If you have such a clean balance sheet, why are you getting creative? I'm sure they're getting creative for CFA reasons. Let's just put it that way. So look, I'd be much more concerned if these debt deals got announced and I saw my credit spread widening out, because then the market is telling me something about how this is being received. I think for a Meta, an Apple, a Google, a Microsoft, issuing $25 billion of debt, to your point, is kind of a drop in the bucket, and I don't think there's too much concern for those
Deals
companies.
are back. Financial engineering is back. We are so back. Stuart, thank you so much for joining us. That is Citi Head of U.S. Equity Trading Strategy, Stuart Kaiser. We are just 8 minutes into your trading session. A check on this equity market, the first trading day of November, and we are higher by 1/3%. Some not very good breath. We are up only 116 stocks are up, but that's enough to carry this market higher because the big dog Nvidia is up. A couple things going on there. Deals abound. Its chips are finally getting sent to the UAE by Microsoft. Amazon's also higher. That is a deal between them and OpenAI. So you announce an AI deal, and congrats, your shares will move higher. You can see it's very concentrated in tech and the gainers. The losers side, you got some of the tech players there too, Apple and Broadcom. Kimberly-Clark, though, down 11.7% after it announced that it will be buying Kenvue. Kenvue has been moving higher this morning. Looking at the sectors themselves, it's Amazon that is dominating what the sectors are doing because it's consumer discretionary at the top of the pile. Consumer discretion, as Matt would say. Amazon leading that sector higher, so it's up 1.9%. But again, Matt, we are back in this environment where the breadth is not good. It is tech carrying us higher. It's Nvidia, and everything else not having that great of a day.
Yeah, that's a risk from a technical analysis standpoint, but everything else seems to be in favor of more gains here. We have a ton of deals. M&A is back in a big way. You've got agreements between the U.S. and China to let us buy more rare earths. They're going to buy apparently more of our soybeans, like they always did before, and it's November, so typically a fantastic month for stocks. Coming up, we're going to get more on today's M&A bonanza as Amazon's $38 billion deal with OpenAI adds fuel to the AI trade. This is Bloomberg Open Interest.
Day of November on the back of a 6-month gain stretch. Will we make it 7? At least off to a promising start. The NASDAQ 100 outperforms, up just under 0.7. The S&P up 0.2, with the Russell 2000 underperforming, down 0.8%. Some of the top calls this morning, the analyst action that we are watching. Cisco, that gets upgraded to a buy at UBS. The analyst there citing a multi-year growth cycle fueled by AI infrastructure demand. Shares up 1.5%. Next up, Morgan Stanley gets its price target, or they boost the price target for SanDisk. That goes to $230 from $96, so a huge price target upgrade. But drop the company as a top pick for whatever reason. The analysts say that the stock's rally means that there's little room for mistakes, though he remains positive on its outlook. Those shares up just under 1%. Finally, Loop Capital Markets, they raised their price target on Nvidia to a street high of $350. Wow. It's a figure, Matt, that would imply a market cap of over $8.5 trillion. They say we're entering the next golden wave of Gen AI, and Nvidia is at the front, kind of sounding a little bit like Dan Ives there. Here's a fun fact from our terminal producer, Dan Curtis. If you took all of the street high price targets for the Mag 7 from Apple to Google and Meta, the group's market cap would go from $22 trillion to $32 trillion.
And those are 12-month price targets,
yes.
Right? So that's like next year.
Yes.
Wow.
I mean, and they've been trying to play catch up a lot, so I don't know, it's not the craziest thing.
I mean, if it's true, we really are in a golden era. Let's talk a little bit about Nvidia right now. Continues to rise, at least today, along with Amazon. Amazon's cloud unit signed a $38 billion deal to give OpenAI access to hundreds of thousands of Nvidia chips. For more, let's bring in Anurag Rana, senior analyst for Bloomberg Intelligence. And Anurag, can you help us to understand what 100,000 chips means? I mean, it could be potato chips as far as I'm concerned, right? Although far more expensive. How much compute do you get from 100,000 Blackwell GPUs?
You know, if you were to ask me that a few years ago, I would say that's a lot. But now we are, hearing about 500,000 chips clusters. So there is this is just getting bigger and bigger every day. But, frankly speaking, the Amazon deal, you would have expected that because of the revised Microsoft OpenAI pact, under which OpenAI has the ability to go out to any cloud provider now. Before, Microsoft had to sign off on it.
Anurag, again, every day it's a new deal, be it Amazon and OpenAI or Microsoft and Iren. With these deals being inked, how much of them are actually in production? How much of the data centers is actually shifting to Gen AI use versus just general cloud?
So this is a very good question, and the answer, it really varies depending on who you are asking. So if you're thinking about, Oracle creating a data center for OpenAI, that's going to take some time. But the deal today basically says OpenAI will have availability of those GPUs under the Amazon Cloud's infrastructure, and that could be actually very near term. So if you remember, Microsoft had you could say, agreement with OpenAI to be the exclusive cloud provider. During that time period, OpenAI was able to go to a handful of them, such as Oracle or CoreWeave. But Amazon was not in that mix because Amazon's the biggest cloud provider with the highest market share. After the agreement was revised and OpenAI had the ability to go anywhere, we had predicted last Thursday that this is a very strong case this is going to happen because AWS has the largest scale distribution network and it has all the chips that people want. So this is a very logical step for OpenAI to go to AWS and add to what they're already doing.
We see so many deals with companies saying they'll get X amount of Nvidia chips. And Nvidia obviously doesn't have an endless supply of chips. So how does Jensen Huang decide, you get 100,000, you get 500,000, I'll give you 1 million? Because that seems to be very important right now.
No, this is always the case. So, I've talked to Kunjan quite about it, who covers Nvidia for us. In his model, he doesn't think chips being a big bottleneck, which means they have the ability to create as many chips for this year as the demand is looking through. Now, how Nvidia distributes it also depends on how big is the cloud provider. When it comes to Amazon and Microsoft, I don't think they will have a problem gaining a lot of the chips. I think another group of companies that will get a lot of the Nvidia chips are the neoclouds, people like CoreWeave, because they are, you could say, a de facto distribution arm for Nvidia. So I think chips is not the roadblock right now. It's usually power.
And that power demand, again, it's another thing that we hear deal activity swirling around, be it nuclear this or nuclear that. Anurag, that's also a timeline that takes a very, very long time to get up and running. So what happens when you have this mismatch of data centers coming online, but the power supply not yet there?
Yeah, I think that is a bigger problem just because it takes a lot longer to get them active. And, we have had one of our energy analysts explain to us that if you want to open a data center, for example, in Virginia, it's going to be very difficult because the power constraints are there. But if you want to go to Michigan, some of the other Midwestern states where there could be excess power at that point, there is a chance you can create some data centers there in a short period of time.
Anurag, thank you so much for joining us. Always really great to get your take. Anurag Rana of Bloomberg Intelligence. Coming up, Kenvue soars as it will be folded into Kimberly-Clark in a $40 billion deal. We have the details next on Bloomberg TV.
This is Bloomberg Open Interest. I'm Matt Miller. Quick check on what stocks are doing to kick off November. And gains have really dissipated. We're only up now 0.1%. It's better than a loss, I guess, if you're long stocks, but 68.50 is the level we're looking at. 68.90 was the high that we reached on a couple of closing sessions last week. NASDAQ 100 gaining more as Nvidia is still putting up some gains and worth more on that index than it is on this. Take a look at Nvidia, now up 2.5% as we get a number of deals with companies claiming that they've clinched a certain amount of Nvidia chips in the deal. Alphabet shares, one of those gainers right now, but only up 0.4%. Iren is up on the Microsoft deal to get compute from Iren. So Iren getting a 20% boost. Microsoft up 1% as well. And Kenvue getting bought. You can see the 18%, I guess the premium's more than that, but 18% gain there. And then Kimberly-Clark getting hit. More than 10% drop at Kimberly-Clark as it makes that deal in stock and cash. Danny?
And just again, on that deal, Matt, it's going to be given an enterprise value of $49 billion. So this is a chunky deal, maybe part of the reason why we are seeing some shares from Kimberly-Clark decline today. Liana Baker, Bloomberg managing editor for U.S. Deals, joins us now. She and her team lead coverage of these big movers. And Liana, this is something Matt and I have been grappling with all day. This is a company spun off from J&J, so clearly didn't work at J&J, didn't really work as a standalone company. Activist investors couldn't figure out how to right-size this company. So how is its fate different under Kimberly-Clark?
It's funny. Yeah, you're right. Kenvue wasn't long for this world as an independent company. Soon after it spun off from J&J, there was even drama with the actual spinoff. I don't know if you remember, there was like an arb play around that. But yes, Starboard's Jeff Smith, a feared activist, is on the board of the company. There was potentially other activists swarming. And then there was also the Tylenol headlines, which didn't help. You know, you can't forget those. So it is really interesting that it gets, snapped up by Kimberly-Clark. There were a lot of rumors, though, swirling for a long time that this wouldn't be an independent company forever.
So how well does it fit into, in an era of deconstructing conglomerates, right? How does it play into the Kimberly-Clark story? Because they already have a ton of different brands that are very diverse. Tylenol and diapers. How do those two go together?
Sure. Well, when you go to the drugstore now, when you're picking up your Huggies and your Kleenex, you could also get, Neutrogena products and Tylenol. So it definitely is an expansion.
If you're a Democrat, right? Certainly not if you're an expectant mother that voted for Donald Trump.
But Kimberly-Clark had been looking to expand in the U.S., but it's aggressive. You mentioned the share drop in Kimberly-Clark. So this is definitely a new direction for them. This is an acquisitive move. Certainly, there were other names around Kenvue that we never confirmed, but this is one that didn't make sense for J&J. So you do see a deconsolidation and then consolidation.
The right move not to answer Matt, by the way, in that specific comment. But okay, even you just saying you go into CVS or whatever store you go to, and everything is now Kimberly-Clark. That immediately, to me, rings alarm bells of competition.
So that is a great question, but Kimberly-Clark doesn't make over-the-counter products. They don't have a competitor to Tylenol or Neutrogena. So it's added in your shopping basket. But let's say a company like Unilever would buy, or P&G would buy Kenvue, then maybe there would be some antitrust risk. Although certainly now antitrust risk is something we're wondering if it's even a concern in deal making, since there's such a M&A boom and decreased regulation.
All right, Liana, great to get you on the program. On this M&A Monday, Liana Baker runs the deals team for us on the BN side. Coming up in the next hour, JPMorgan Sitara Sundar joins us, and she's going to tell us where she's putting money to work now. Plus, we're going to speak with the president of PIMCO, Christian Stracke, about credit markets amid a, quote, emerging default cycle. And Link Logistics CEO Luke Petherbridge joins us on the health of the last mile supply chain. This is Bloomberg Open Interest. We are 30 minutes into the trading day and watching gains dissipate. Welcome to Bloomberg Open Interest. I'm Matt Miller.
And I'm Danny Berger. It is the first trading day of November, but even so, it's off the back of 6 months of gains.
Yeah, and as you pointed out, breadth was not good, right?
Really
in terms of the S&P 500, we saw only 100 stocks gaining, about 400 stocks were losers, and as a result, we have this little bit of a turnaround here. We've got breaking data on the economy. We got S&P Global U.S. Manufacturing PMIs out earlier. They were pretty much in line with what we expected. Now we're getting ISM manufacturing, and it is a little bit worse than had been anticipated. Bloomberg's international economics and policy correspondent Michael McKee here on set to help us break it down. Mike, what do you see?
Well, it's kind of mixed news. The headline 48.7 is down from 49.1 last month, and it doesn't match up with the expected rise in the Economist survey. But prices paid a little lower, 58 even, down from 61.9. New orders are up to 49.4, still contraction, but better than 48.9 last month. And employment, 46. That's a little bit better than 45.3 that we had in the month of September. But again, it does suggest contraction. And of course, any information we get on the labor market these days gets absorbed pretty quickly by the markets. Imports, 45.4, up from 44.7. We're obviously watching that to see if companies are trying to bring in more stuff. And I guess they're bringing in a little more stuff, but we don't know what the price situation is on that. We're not getting import prices these days. So overall, kind of a mixed report, but still not good for the overall manufacturing economy. There was hope we saw a little bit of a rebound in October, but according to the ISM, we didn't.
And maybe for that reason, you are seeing yields come in. Some of the higher push in yields is starting to drop, though we are still down on the day. Michael, how much more important is this data, just given the fog that we are in the words
purple
of
haze, as Amanda Gotti
I don't think
says.
Chair Powell called it a purple haze.
No, that's
for what it's worth.
Amanda Gotti of PNC says
No, I
the
know,
purple haze of policy, which I love.
But Powell called it a fog, hence why I'm calling it a fog.
But it's fair, he wears a purple tie all the time. So, I mean, when you go back to what he said at his news conference, they have enough information to get a pretty good picture of where the economy is, and this will feed into that. And the important thing is, he noted that if there's a turning point, they'll be able to pick it up. And this is not turning point kind of changes. It just shows you that things are still kind of chugging along at about where they were before the government shut down.
Yeah, just like the two-year yield before we got this data, just right back where it was. Michael McKee, thanks so much for joining us. Let's talk now with Sitara Sundar, JPMorgan Private Bank Head of Alternative Investment Strategy. And Sitara, it's great to have you on as we, try and decipher what's going on with an economy that looks so strong, right? And these cockroaches that are scurrying around on the kitchen floor. What do you think about the state of credit as we see a blow up here, a blow up there, and prepare for more and more defaults?
Yeah, definitely. I think it's the number one question that we're thinking about outside of what's happening with deal making in private equity is what's going on within broader credit markets and what that means for private credit. Holistically, the way we think about it is segmenting it into two different risks. One are the select idiosyncratic defaults that we're seeing within the credit market now, emblematic of a systemic problem. And then two, what is our outlook for private credit moving forward in a period of time where defaults might be rising while base rates are falling? On the first part, holistically, we do believe that while private credit has grown meaningfully, the whole assets under management within that market has grown at about a 14.5% annualized rate over the past 10 years. That's meaningfully more than what we've seen in corporate borrowing holistically. But we do not believe that the growth that we've seen within private credit markets is detrimental to the economy and posing of a systemic risk. Actually, if you look at private credit AUM, it is still only 9% of all corporate borrowing. So we still feel comfortable with that. Two, what we do believe, though, is with any situation in which you see capital flooding into a market, what you will likely see is there are going to be pockets of idiosyncratic risk that will bubble up, and we wouldn't be surprised to see defaults increase a bit within the market. We're actually projecting about a 2.5% default rate within broad private credit over the next 10 years. But that just means that manager selection is extremely important.
But to be clear,
yes,
capital is still flooding into private assets, including private credit.
And it is. Like, overall, holistically, we are still seeing growth in capital within private credit, but within and private equity. But the flip side of that is Is that warranted? And we believe yes, because the opportunity set in private markets is increasing as well. Even, I mean, we talk ad nauseum, we all do, about artificial intelligence. And when you think about the growth potential within artificial intelligence, increasingly we believe that private markets are going to play a very meaningful role in that evolution. Just think about the median tech IPO. The median tech IPO now is at about 14 years old, and the size of revenues that are associated with that is 220 million. If you look at that during the last big tech revolution, when you think about .com and to a certain extent cloud, the age of a tech IPO was 8 years old and sub 45 million in revenue. There's a meaningful amount of value creation. So we think the capital coming into the market is to find those deals.
But even so, you do have, I don't know if distortions is the right word, but just kind of weird phenomenon where, for example, all of these tech giants coming to the broadly syndicate market get snapped up so easily. Meta puts all of this debt out in the market absorbs it with no problem, even while its equity is selling off. Is there, maybe it's still the right time to be buying this, but is there a situation where just the amount of capital means the risk and current risks aren't completely reflected in what people are willing to pay?
Look, there is a lot of parts of the market that are priced to perfection, which is why we monitor a lot at what's happening in earnings season, whether or not guidance is actually being revised higher, which it has been. But then two, I think the important point to remember as well is if there's demand for the capital and utilization of that capital, then it should be okay, because that means the returns will come. And dissimilarly, in the best parallel is like the fiber optic build out in the internet timeframe. What you actually saw there was too much capital and an over build out. There was 97% of the fiber optic cables that were built during that period of time were not utilized. We are still now in a compute-constrained economy. We are still in a compute-constrained economy.
But next year, or in 2 years, it could be vastly different, right?
It could be different, but we still believe that the demand is only going to grow because corporate adoption is still growing. Even just this year, corporates are about like 10% adoption rate versus, a quarter of that at the beginning of this year, and we think that's only going to accelerate moving forward. So we think that we'll be in a compute-constrained economy for multiple years.
Is there anything that worries you right now? I mean, it's a market that has rate cuts delivered and maybe more to come. You have corporate health of America is still really strong. Is there anything that can derail sort of the bullish sentiment that's swirling around markets right now?
Inflation is probably one of the areas where we're hyper-focused. The reason for that, we're actually expecting that over the next decade, inflation is likely going to land above the Fed's target, call it 2.5% US CPI projection moving forward. That's meaningful in terms of what that means for portfolio construction, because as we all know, longer duration and core fixed income bonds don't always provide the best hedge against inflation risks. So for us, we believe very strongly that portfolios are going to need to evolve to hedge against that risk, and that means things like gold, that means infrastructure, that means real estate, and providing pockets of your portfolio that are actually going to be able to embed inflation-resilient income or a hedge against geopolitical risk. Those are probably the two big things that we're monitoring.
We have a viewer listening to details of the flood and wondering, where is all this capital coming from? And I mean, you could ask the same question about global liquidity, right? It seems like it's off the hook. If I look at money supply, it has turned and continues to rise now. So where is all this capital into private assets coming from?
There's a mix between institutional and retail, but if you think about the inflection higher that we're expecting to see in growth rates of capital moving forward, a lot of that is coming from the retail investor. And part of that is emblematic of this idea that we're seeing democratization of alternatives, which we think to be a good thing as long as it's done prudently and selectively, because all of a sudden, all of this growth that's happening within the private markets is now accessible to a broader group of people, which has meaningful ramifications for return potential and portfolios moving forward.
Sitara, thank you so much for joining us this morning. Always a pleasure to have you on. Sitara Sundar of JPMorgan Private Bank. A quick check on your markets this morning. We are heading higher, but increasingly losing some of those gains, only up 0.1%. The latest was that ISM data maybe coming out a little bit weaker. You are looking at yields on the 10-year still up by 2 basis points. The NASDAQ outperforms up 0.5%, Matt.
Let's get a look at some of the single stocks on the move this hour. Amazon's cloud unit has signed a $38 billion deal to supply OpenAI with computing power, providing access to hundreds of thousands of Nvidia chips at AWS. So you see both of those stocks are up.
And another AI deal, Microsoft inking a $9.7 billion one to buy cloud capacity from Australia's Iren. That gives it access to, you guessed it, more Nvidia chips.
And Kimberly-Clark has agreed to buy Kenvue for roughly $40 billion, providing a lifeline to the struggling maker of Tylenol and Band-Aids.
Coming up, a conversation you don't want to miss. We will speak to PIMCO President Christian Stracke. He joins the show as tech giants continue to fund their AI spend through debt. This is Bloomberg Open Interest.
Let's get now to high interest. Look at what's making headlines around the world. Bank of America CEO Brian Moynihan faces a tough crowd this week. The stock has trailed every major U.S. rival for 5 straight years, and he's hosting his first investor day in nearly 15 years to explain why responsible growth still works. The drag traces back to 2021 when the bank poured deposits into low-yield bonds just before rates spike. Moynihan argues the bank is catching up. Net interest income should rise up to 7% next year as those old investments mature. And Izzy Englander sold about 15% of his hedge fund Millennium Management to a mix of institutions, wealthy investors, and top executives in a deal that values the firm at $14 billion. The $2 billion stake marks a step towards succession for the 77-year-old founder who has a long way to sail. The move signals a new era for one of the world's biggest multi-strat hedge funds. And Alphabet is tapping the bond market for an additional $15 billion in debt in a deal that's split into as many as 8 tranches with maturities from 3 to 50 years. The proceeds will be used for general corporate purposes, including debt repayment, although it barely has that much on the books. The offering adds to a flurry of tech debt recently as firms race to fund massive AI investments. Of course, Meta last week issued $30 billion in bonds. Danny?
And some big funds are getting in on the action, including PIMCO. They took a pretty paper profit from the $27 billion debt package that it led for a Meta data center. I'm pleased to say PIMCO President Christian Stracke joins us now. Christian, I mean, big tech has been raising a lot of money in these IG markets, $75 billion for AI data centers. How much does it change the contours of this debt market to have tech players who traditionally shied away to be participating in a very large way?
Yeah, well, thanks, Danny, and great to see you again. It changes it, but look, these are ultimately very strong investment-grade credits, and yes, they have a moment, and they have a moment which is that where they do need to drive fixed investment. They need to build out the AI infrastructure for all of the growth that's coming, and to do so, they need to borrow. Now, in some cases, some of the opportunities are interesting, but not necessarily all that compelling. In others, where you are doing secured project finance lending backed by the data centers that are getting built out with a strong lease to the strong IG tenant, that, in our view, is a very compelling opportunity set. And we've seen some of those opportunities in recent months. We expect that there will be more to come.
And of course, you're perhaps referring to your Meta deal there, Christian. So you are looking for these high quality tenants in data centers and when you participate in these debt deals. But as you're getting inbounds for different deals, as you're sorting through different things, are there pockets where you say this is a deal we would never do and kind of raises concerns of froth?
Sure, yeah, no, there's definitely some of that. Anything that's built on spec, so data centers that are built on spec where there's not clear line of sight into who is going to be the tenant or how is the tenant going to use it, that is froth. And there will be money wasted in that space and there will be stranded assets in that space. And so in our view, much better to take a little bit lower return, but still very compelling returns relative to other secondary options in investment grade credit, where you're close to the project, you're close to the asset, but you also have a very strong tenant coming into the opportunity. But yes, there are those deals out there that are much more spec-like, and there will be more of those to come, and there will be losses in a lot of this space.
Bloomberg put out a story today. Our data shows nearly 100 new zombie companies last month that haven't been able to cover their interest expense with revenue. Are you worried that this could be the start of a default cycle?
Look, the default cycle is already underway. I mean, we've been talking about that for the better part of this year. We've got defaults in bank loan space, so that would be below investment grade bank loans that are running around 4% over the last 12 months, and that will probably be the case over the course of this year. And some of the big examples of defaults that we've seen in recent months are part of that default cycle. So the default cycle is underway, and it will continue into next year. And still, companies are struggling, as you mentioned, with high interest costs. Yes, rates are coming down. The Fed is bringing rates down, but still they're a lot higher than they were when a lot of these deals got done. And at the same time, the growth is not there in a lot of these sectors that where people expected the growth would be. Tariffs are part of that. The slowdown in labor force growth is part of that. Slowdown in housing and property is part of that. There are a lot of different reasons why the growth isn't there, but that combination of rates higher than you expected and growth lower than you expected is creating these zombie companies, and those defaults will continue. But it's going to be pretty manageable. A 4 or 5% default rate in bank loans is higher than you'd like to see, but manageable. And if we see something on that order again next year, again, higher than you'd like to see, there will be winners, there will be losers, but ultimately nothing that rises to the level of systemic or really challenging the dominant narrative out there in markets.
Christian, it hasn't hurt treasuries. We just showed the 10-year yield, at the beginning of the year, 4.80, and now we're down at 4 even. A couple of days last week, even below that level. Even though we've had these sweeping tariffs from the Trump administration, tax cuts for the wealthy, budget deficits that are, continuing to grow and grow and grow, as well as attacks on the Federal Reserve independence. You would have thought that created a sell America trade, and yet it hasn't happened. Is it still to come?
Well, I think what we're seeing is that inflation is problematic this year. Certainly, there is a tariff pass-through into inflation. But over time, we have strong line of sight to inflation coming down, maybe not to the Fed's target of 2% by the end of next year, but getting closer to it by the end of next year. And so that will allow the Fed to continue to cut rates, and that allows the longer end of the curve, the 10-year part of the curve, to continue to come down like we've seen this year. And what we've also seen is that a lot of the world is underinvested in fixed income, overinvested in equities, as equities have done extremely well. And so a lot of the world is looking at rates around 4% in the U.S. That offers really high-quality return, high-quality income. And then it's not just about treasuries, of course. It's all of the high-quality fixed income opportunities that you see in fixed income, whether that's securitized credit, whether that's agency mortgages, whether that's some investment-grade corporate credit as well. There's a lot of opportunity out there. And a world underinvested in income, a world underinvested in fixed income is adding at these levels. Yes, inflation remains a concern, and that is something that we're very focused on, and one cannot be complacent about it. But it is our fairly strong view that over the course of next year, you start to see inflation continuing to come down, helping the Fed to cut rates over the course of next year.
So, Christian, just listening to you, is it fair that all this hype about a debasement trade, that's the reason everyone's flocking to gold and Bitcoin, that narrative was just wrong?
Well, gold and Bitcoin are much, much, much smaller than the stock of fixed income out there. And so, it doesn't take much buying to drive gold and Bitcoin to higher levels. I think what's much more relevant is the fact that there are very strong flows into fixed income, given that there are very interesting opportunities in high-quality fixed income. And there were fears around, as what you said, debasement, fears around sovereign credit, and certainly deficits are high, deficits are problematic. But we've seen is that there should be some stabilization in the deficit at a high level over the course of this year and into next year. Not a great place to be, but certainly better than one might have feared earlier this year.
Christian, just talking about the flows into fixed income, this is something Matt and I have discussed a lot, that you can get these huge bond offerings from the tech giants and IG markets barely change, that you can have days where there's broader concern in equity markets, but spreads are unmoved. In private credit, you have this whole new swath of wealth investors coming in too. The sheer amount of capital coming in to credit markets, does that mean that there are some pockets where fundamentals and risks aren't exactly reflected?
Yeah, I mean, it's certainly the case that there is a lot of complacency in credit markets, and there has been for the last couple of years. What you see is that people who are underinvested in fixed income are, in some ways, in some cases, being relatively indiscriminate in coming into credit markets. You see that particularly in the passive space. In passive credit investing, the more somebody borrows, the more you lend to them. That is the definition of passive in credit, and there is a fair amount of that. Then you also see it in below investment grade, where there's been a demand for higher yields, higher returns, and there we're starting to see those defaults come in, and that's shaking up some of that complacency. So yes, this has definitely been a theme over the course of this year, as we've seen this emerging default wave that was likely to continue into next year. That said, if you step back, the broad universe in corporate credit, IG, is in pretty good condition.
Christian, great to get some time with you. Really appreciate it. PIMCO President Christian Stracke talking to us from London. This is Bloomberg.
Let's get a check on these equity markets. S&P 500 futures turning negative this morning after a positive October, the sixth consecutive month where we have seen that. It is narrow breath. It was always narrow breath to start this market, but it's really taking its impact now. NASDAQ 100 stocks are up by 0.33%. Coming up, we take a look at how the easing tensions between U.S. and China are impacting industrial real estate. The U.S. and China, after last week's meetings between President Trump and Xi, seemingly, at least for now, hitting the pause button on escalating trade tensions. Both countries agreeing to halt certain tariffs, including Trump's plan of an 100% tariff on Chinese exports to the U.S. and a downgrade when it came to fentanyl tariff. For a look at how that's impacting businesses ahead of the crucial holiday season, we welcome Luke Petherbridge, CEO of Link Logistics. Link owns warehouses across the U.S. with over 8,000 customers across all facets of the economy. And what was the stat of how much of U.S. GDP your warehouses are equivalent to?
About 4 to 5% of U.S. GDP, our 8,000 customers operate. So it's pretty incredible.
It's an insane amount, and it's such a good look into this economy. So we're about to head into the season where everybody's buying holiday gifts and deciding what to shop for. How do inventories look, and what is the sentiment among retailers that you work with?
Yeah, I mean, it's a really interesting time. We're just talking about the economy. What we're seeing is general resilience. And when you think of supply chain, our customers, and we just were with our largest customers, they think a very long term. So they're seeing robust inventory levels. They're actually prepared well. And I think what we've actually seen is we've actually leased more space this year than we did last year. And you think about what the economy we've been dealing with and some of the tariff noise, they're looking right through that at the moment.
That tariff noise, I would imagine, creates volatility for a business like yours, because if I hear that I'm going to get 100% tariff on the place where I import all my goods next month, I'm going to import as much as I can right now, right? And then after next month, none. So do you see that as well?
Matt, sounds like you're a supply chain person. That's exactly what they've been doing. I think it's a really good point. I think uncertainty is the issue. Like, if you think about it, we've had tariffs before. We had tariffs a decade ago. We've been having tariffs. The change in tariffs, I think, is the issue. What we're seeing is tariffs are settling. We saw that again over the weekend. That obviously provides greater certainty, and our customers react that way. So, yes, it's been a little lumpy this year, but when you think of supply chain, you really are sort of building out your supply chain for not just 1 year, 2 years, 3 years, it's 5, 10 years. The other thing that's happening is e-commerce continues to be a bellwether for the country and for our business, and we continue to see that growing with the traditional e-commerce providers. But then also retailers continuing to grow their e-commerce presence. And then finally, I would say speed is what's happening. I mean, I have teenage kids. They're not waiting a week for things to be delivered. It's 24 hours or less. What that means is you need to be closer to the customer, have more inventory to deliver and fulfill the promises to your customers.
There was this whole narrative that after COVID, Amazon spent too much on last mile logistics, that they had to pull back in that spending. But just hearing what you're saying, it seems like you can't really have spent too much, that the demand is really there. Where do we stand in the build out of last mile logistics and aiding some of the digital retail trends that you're talking about?
Do you know, I think it's a really good point, Danny. The first phase was really Amazon's taking share. Now it's all the other retailers catching up. I mean, you look at Walmart and the growth of their e-commerce business, double-digit. Amazon last week, double-digit e-commerce growth, which is really incredible for a business that size. I think the second wave of e-commerce now is speed. What used to be totally adequate to deliver in 5 days, you now need to deliver in 24 hours. So what that does to your network, you need more warehouses closer to consumers.
And more tired drivers? I just feel bad for the people behind that are having to put out stuff in a day after being ordered.
And so then what happens is, because you've got such a large network, you're able to actually use whether your store or the facility to be able to do that. But that is now the expectation of the customer. The customer is always right, and businesses are working around that.
Well, and you're going to have in your warehouses, in a lot of cases, I imagine, robots or automated systems. You've got a lot of warehouse space that needs to be climate controlled, lights, water, et cetera. Probably not the same power needs as an AI data center, but you're getting there in a lot of places, right? How do you deal with that?
Yeah, do you know, power is a huge topic. We just had as I mentioned, our largest customers together. That is now one of the biggest concerns they have, is accessing power. We really have built out a fulsome solution for our customers. We're a very large landlord. We try to access the grid for them. But it is becoming a challenge.
You're a gigantic landlord. 500 million square feet of space, right? 3,500.
It's 3,500 buildings, 8,000 customers. There's a lot, but our customers, whether you're a big landlord or a small one, you are still dealing with the same challenges. The one thing you talked on data centres, another area that we're seeing real growth is this reindustrialisation of the country. You're seeing manufacturing. We've seen, over 200 announcements in the last 5 years, $500 billion of factories and starts. That provides another buoy towards our business. But again, there's an increasing need while there's diminishing new supply. We're not building enough warehouses going forward.
The thing that seems incredibly complicated to me, you're talking about how your customers are planning 7 to 10 years ahead. But that one will be a different administration, so who knows what the policy mix will be like? Who knows what immigration will look like then, too? How difficult is it even to plan for the long term right now?
Yeah, it's really hard. But when you think of these very large corporations or big 3PLs, they have a really long-term strategy to provide network support and supply chain logistics for a country that's going to grow, consumption's going to grow, but they need to think through that. So there is a lot of near-term noise. We don't discount that. That is important. We try to work with our customers, provide them flexibility, the benefit, Matt, of having 500 million feet. We can help expand and contract customers when needed. But customers are thinking, if you think of the largest retailers or manufacturers, they think very, very long term to get component parts into the country and into the widgets or the supply chain that they're running.
Well, and regardless of the policy changes, you can't go wrong with supply chain localization, right? I mean, no one's going to raise tariffs on ourselves. Well, I don't think they're going to do that. So how big a part of that is your business as well?
Like, you mean the localization?
Yes.
I'd say we really have tried to skew towards last mile. We think that is a growing area. We think being close to rooftops, close to workers. Remember, we talked about automating the facilities. Most of our facilities have millions of people turning up across our entire portfolio every day, being close to the workforce. And again, as we talked about, speed is now the final frontier.
Well, be close to the customer.
Yeah, and speed is the final frontier. You are trying to chase speed. I mean, Amazon has set a pace, Walmart is chasing it, and then others are following through. So, and it's not just to the end customer, it's also supply chain inside any sort of manufacturing network, having component parts there when you need them immediately to keep the supply chain moving. We continue to see that chase for speed as one of the key components for all our customers, and we continue to try to own real estate in the path of that growth.
Hey, Luke, just quickly before you go, I'd be remiss if I didn't ask about Core Giving, the charity that you co-founded and are chairman of, about food insecurity. Because it's part of the conversation right now with the government shutdown and the SNAP benefits running out, how big of an issue is food insecurity in this country right now, especially with the government shutdown?
Well, thank you for asking about that. It's something that's very close to my heart and the heart of all our firm. The stat from Feeding America, 1 in 5 children don't know where their next meal's coming from. And that's a shocking statistic for this country. It's something that we in Core Giving and all our portfolio companies work on. 2 weeks ago, we had Call Giving Day, where 3,500 colleagues across 20 different portcos around the world gave back. But it is a real issue. And I would say even before what's happening right now with the snap, it's still an issue, and it's something that we need to solve. And it's in every single community that's around the country. And we're trying to do that and help that wherever we can.
All right. Great to have you on the program. I think an absolutely fascinating business. So fun to hear from Luke Petherbridge. He's the CEO of Link Logistics. Now let's get a check on what's going on in markets right now. We saw big gains at the top of the session, and now we're looking at red arrows here. The S&P down about 0.2% with the NASDAQ going 0.2 the other direction. The 10-year yield right now at 4.1046, so still fairly low, but at a 3-week high.
And then meanwhile, some of the single stocks that are moving in this hour, we're still keeping an eye on Nvidia shares. Loop Capital says the chip maker can hit $8.5 trillion in market cap, a huge amount. Reminder, it's at 5 now. Loop raised its price target on Nvidia to a street high of $350. That's up from $250.
I'll say $400.
Sorry?
I'll say $400.
Okay, I keep
what do you say, Danny?
You know what? To the moon, 1,000. I don't know.
Okay. Palantir is expected to see revenue growth of about 50% when it reports after the bell today. This, according to Bloomberg estimates. But concerns about Palantir's valuation remain. It hasn't stopped the stock's run thus far.
Meanwhile, Pfizer has sued Metsera and Novo Nordisk in an effort to block Novo's bid for the obesity startup. They say Metsera breached their earlier merger agreement.
Coming up, we are live in Sao Paulo ahead of the COP30 Climate Summit. UN Assistant Secretary General Marcos Neto joins us next. This is Bloomberg Open Interest.
In the run-up to COP30 in Brazil, business and financial leaders are gathering in Sao Paulo to discuss navigating climate risk and investing in innovation at a time when flattening the emissions curve is getting more and more critical, and former climate leaders like the U.S. are retreating. Vonnie Quinn now joined by the Assistant Secretary General of the United Nations Development Program. Vonnie.
Danny, thank you so much. Mr. Marcos Neto, welcome and thank you for joining. One of the main points of business is to update the NDCs. It's been 5 years since the last one. What will be new about these new nationally determined contributions, which are so important for countries?
Good afternoon. It's a pleasure to be with you. This is fundamental, as you said. I think in Belém, we're going to have a third generation of national determined contribution, the NDCs, and those NDCs are much better. They are more ambitious. They are 100% have energy transition in them. 87% of them is dealing with adaptation. And more important, as we're having a conversation about private finance and private capital, the NDCs now, most of them have a budget for the first time. They have the beginning of financial plan, and they will be able to be used to break down supply chains and find the pipeline country by country that which the domestic and international private sector can start to mobilize.
Because there was concern that only a third of countries had actually submitted them in time for the UN report. The EU hasn't even got around to submitting. It's expected to tomorrow.
Indeed. But what happened was there was the Secretary General of the UN called a meeting, a climate summit in September in New York. And for example, in there, 121 governments have actually presented the NDC targets. So we know that the actual official submission to the UNFCCC, only 67 have gone in, but we know there's 121 that have their targets done. So I think we are going to, my colleagues at the convention are going to be able to issue an annex synthesis report later after the COP. But we know that we as UNDP have actually supported 102 countries in getting the NDCs better, more ambitious, more inclusive, something that is the whole of economy and deals with poverty as well.
Exactly. How significant is the US retreat from the climate goal globally? Will it be hanging over COP30 this year? And for example, just in terms of trying to flatten the emissions curve or reduce the green premium, will it have an impact?
Look, the United States is a very powerful country. Of course it has its impact. But I think this is not the first time around the US leave the Paris Agreement. I think the world has learned how to move forward the agenda without the US. It is the US's choice. It is regrettable, but at the end of the day, every country makes their choice. The important point is the rest of the world is going to come to Berlin, are doing the NDCs, and the agenda goes forward.
Speaking of the rest of the world, China is coming, a vice premier is coming, and China did submit an NDC, maybe a modest one, but all the same. How much do you expect China to step up to the plate and maybe take on the climate battle, become one of the leaders in place of the US?
Oh, I think China is already a leader. I think no country in the world domestically does more on the energy transition than China. Production of EVs, right? The production of solar panels, winds. So China is really at the forefront in that transition domestically. I think the Chinese NDC is an indication that he's ready to, hopefully, together with the European Union, to lead the world in the next few years on managing the climate crisis.
You were, in fact, born in Belém, the gateway to the Amazon, so you've seen the crushing cycle of poverty and deforestation that happens in communities like Belém, and the need for global growth to decouple maybe from taking down the emissions curve. Now, Bill Gates has written a letter on this saying that if there's a certain amount of money, perhaps some of it should be diverted now, that we shouldn't be talking about just climate, we need to be talking about human welfare. What are your thoughts, given that you come from Belém, where more than half of the population lives in favelas?
Well, I am a son of Belém. I'm going home. But more important, I've spent a career of 30 years in development. I think it is a false dichotomy to now say that, you have to invest in health, not in climate. We invest in climate and health, right? Climate change is an accelerator of development challenges. The important point for us is to actually look at how a dollar can take, for example, we know that implementing the NDCs can take 175 million people out of poverty, just by implementing the NDCs. We know we can add the economy of Sweden, right, to the global GDP if we implement the NDCs. So I don't understand this notion that, the money needs to go in one place or the other. The money needs to go to the convergence between climate and development.
Briefly, NASA has confirmed that last year was the hottest on record. And if all of the countries that have pledged these NDCs keep to them, that still only reduces emissions by 4%. We're not anywhere near the Paris climate goals. It would take another 28% of a drop to get to where we wanted to be for 2030. How concerned are you about extreme weather?
Extreme weather is going to fundamentally affect every community, from the rich to the poorest, across the world, right? There were floods in New York this week before I flew over down here. So we have to invest on the adaptation side. Even if we come down to 28%, we've already put enough CO2 equivalent in the air that we're going to have to invest on adaptation for a century or more. And I think that's part of the Brazilian presidency of the COP, is the focus on adaptation. And we as UNDP are very much behind that.
So many conversations to be had over the next 2.5 weeks. Mr. Neto, thank you so much for joining Bloomberg TV. Danny and Matt.
Vonnie, thank you very much for that excellent conversation. Bloomberg's Vonnie Quinn reporting live from COP30 in Brazil. Coming up, Visa releases its 2025 holiday spending outlook. We speak to Wayne Best, the company's chief economist, on it. That's coming up next. You're watching Bloomberg TV.
Visa releasing the results of its 2025 holiday spending outlook. It found that while holiday shopping is expected to grow, there are major differences in spending by generation. Gen Z, millennials, and Gen X are expecting modest growth, but the baby boomers expect to spend 21% more on gifts, which is probably good news for the rest of us. Joining us now is Wayne Best, Visa chief economist. And Wayne, I've heard insane estimates of how much wealth the baby boomers have. I think $75 trillion is one that Sally Krawcheck told us, but I've heard even bigger numbers. So I guess they're just planning on giving away more of that in terms of gifts this holiday season.
Well, they have more kids to give to, grandkids specifically. I certainly fall into that category. So they're going to be sharing a little bit more of those holiday spending associated with that. They're obviously aware of the prices that we're seeing and the inflation that has taken into effect. But this is that stage of life when we see boomers and, largest generation to come along until the millennial generation. Yes, they have that wealth and they're going to spend it.
I hope your grandkids are listening, and if they are, they're probably very excited about what's to come for Christmas, Wayne. When it comes to younger generations, though, we've heard some of corporate America start to express concerns. Chipotle and Shake Shack stand out as two, saying our results weren't as good because people under the age of 30 just aren't spending as much. Are you also seeing that trend that younger people, especially with a higher jobless rate, are pulling back on spending?
I think that there is some moderation that's definitely going on. The good news is if they're working and if they have a house, they're certainly doing very well in terms of their picture. And also we have to look at the level of indebtedness of consumers. And when you look at that as a share of income, it's actually also pretty positive. It's lower than where we were pre-COVID. So there is the might behind it. It's just that consumers have to have the confidence that moving forward, they're likely to remain employed and be able to spend in that regard.
We have, you know, a kind of a bullish outlook in terms of holiday spending. I think you expect a 4.6% year-over-year rise. At the same time, I got a note from Torsten Slok of Apollo today saying that 25% of Americans are subprime. And we've been talking about for weeks now the fact that 42 million Americans are on food stamps. How do you sort of juxtapose those two sides of the coin?
Sure. So I think let's start first with the holiday sales number. You asked 4.6% versus 4.3% last year. And it's important always when you talk about holiday sales to understand what the definition is. We're looking at November and December retail sales less autos, gas, and restaurants. That's specifically, and it's a non-seasonally adjusted number. So that's a common metric that's used there. But if we break that down into the real spending, taking out the inflationary component, the growth is much slower. Obviously, 2.2% is what we're expecting. That's down from 2.5% last year. So we have adjusted some of our forecast given the challenges that remain with regards to subprime audiences as well as the government shutdown. That'll be an important factor as we lead into the season.
Wayne, when you look at the upper echelon of consumers, the people that we've seen reflected, for example, in the airline earnings and travel, how price sensitive are they at the moment? Across the board, are consumers still willing to pay more, or are you seeing softness there?
I think what you see is that obviously the wealthy are going to be looking for a bargain also. And let's remember, for all consumers, we've got more tools available to us now than we ever have before. Not only consumers, but also small businesses. If something's going up in price, I can price shop it now, sort by price, and I can find something online that's much better and at a cheaper price. So I think the sensitivity is absolutely there, even for the wealthy. And that's going to play importantly, especially as we continue to look into the holiday season. Consumers, again, are expected to spend, about 10% more on gifts overall, but the boomers are going to see about 21% lift. So again, a lot more spending that can occur in this holiday season.
Wayne, great to get some time with you. Hope we have you back soon. Wayne Best there, who is the chief economist over at Visa. As we come to the end of the hour, let's get a check on what's going on in markets. We started out with some gains and now are a little changed on the S&P 500. We've been fluctuating back and forth, but the NASDAQ continues to remain strong.
Maybe some of the weaker ISMs taking a chunk out of the gains for the S&P, and maybe it's that we don't have tech earnings this week to lift us up, but we have plenty of AI deals that seems to be making this market happy.
Yeah, coming up tomorrow, Kristen Bitterly of Citi joins us, as well as a big bull, John Stoltzfus of Oppenheimer. In fact, he's the biggest bull on Wall Street. Plus, Galaxy Digital co-founder David Namdar joins us to talk crypto after the fall of Bitcoin. Still pretty high, though. This is Bloomberg Open Interest.